Joining us is Grant Nader. He is a senior portfolio manager at Benguela Global. Grant, it's great to talk to you. Thanks very much indeed for coming on. Do you want to begin by talking us through the Rand and JSE's performance this Thursday mid-morning?
Well, good afternoon. We have seen, Michelle, an improvement in the outlook, certainly around the local counters. Yesterday afternoon, post the budget, the financials, industrials, they were much better bid than other stocks in the market, and we saw that again today. There's a bit of broad-based strength, I would say, and it really tells me you're seeing it in the Rand as well, which is holding comfortably below 19, holding on to some of the gains from yesterday. And it does tell you that if not, perhaps the budget wasn't fantastic, but it certainly wasn't negative. There was enough in there to take some positivity out of it. It stabilized the currency. We've also seen the long-end yields come down, which is also a positive sign. And so there's a generally better bid around in the market, especially with regard to South African-focused companies. So that I find rather encouraging.
We've had quite a bit of difficult news coming out of the mining industry lately, right? More concerning news coming out of Anglo-American, reporting weak prices, higher costs at its diamond, platinum and iron ore businesses. In fact, their full-year profits plunging by 94%. I would argue to say that that's almost unheard of, is it?
Look, the mining is a notoriously cyclical industry, and of course there's always a lot of write-downs and impairments in the lows of the cycle. So if we look through at the underlying EBITDA, that was down 31%. So yes, earnings were down significantly, but the underlying businesses, especially around the copper, the iron ore, they're solid. They are doing well. The price of copper and iron ore has actually held up fairly well. What's hurt Anglos is we're in the cycle lows of PGMs and diamonds. So both of those have had a very tough year, and the collective basket price then across all of their commodities will have come down significantly. The question becomes, is this a cycle low or is it a structural low? And what is the outlook for the PGMs and the diamonds at this point? Diamonds are under pressure from these manufactured or industrial diamonds, and the PGM space is under pressure, as we know, with the advent of electric vehicles and alternatives to the internal combustion engine. So I think overall, Anglos is doing what they can. They've announced some considerable restructuring plans. They're going to refocus the portfolio on what they see as the structurally better assets, the likes of copper, iron ore, etc. So what that asks, it does ask the question of what becomes of these other assets, the PGMs, and that in the past they haven't been scared to divest of assets. We saw them spin off coal, we saw them spin off gold. So it's going to be a space we need to watch to see what they do here.
Yeah. Shall we stay with news around Anglo? The company also announcing that it secured additional multi-billion-ton high-quality iron ore resources. What does that mean, especially now for the miners' ability to turn the business around, at least in the medium term?
I think that's certainly a positive. So the deal they've done with Vale is an untapped ore body that has a higher quality than their existing Minas Rio ore body, and they are right next to one another. So they'll be able to expand the mine into this ore body. Also, there's a logistics network, a rail and port network that Vale operates that they can tap into as well, which then, of course, increases the cost benefits of distributing this and exporting it. So that looks to me like a good deal. And I think it's the kind of thing you want to see. They're moving into something where the long-term outlook still remains very positive. As we move away from dirty industry, the higher quality iron ore commands a premium because it produces less pollution than the lower quality. So that asset will be even more valuable as time goes on. So it's a good deal. These things take a long time to actually monetize, and they take a lot of investment first and capex. So we need to be aware of that. But over the sort of medium term, I think this could be a good asset, and it's a good move.
Yeah. The mining sector, plenty of moves there. Diversified gold miner Gold Fields planning to boost production in the next 24 months with its mine in Chile, due to come online in April. What are the miners' plans, do you reckon, for its operations in South Africa? If we recall, there was a production dip last year.
So that South African mine is a difficult mine. The South Deep mine is probably the largest gold ore body in the world at around 32 million ounces. but it has been an incredible, tough and long journey to mine it and to monetize that mine. So they are productive now. They're producing around 330,000 ounces. But they have sunk tens of billions into that mine, and there's no way they're going to walk away from it now. There's way too much invested. So we also saw a union wage agreement they signed last year. So it's stable now, and it does help that gold prices are at good levels. And so the outlook, at least for the next 2 to 3 years, remains stable. There's certainly no talk of restructuring and downsizing in that South African operation, and I find that very encouraging. And I think the production is stable enough. It's down a little bit, but even if it just holds these levels and gold prices play ball and they manage the costs, it'll still be still a productive asset. So I think there's nothing to be concerned about there.
Yeah. Let's look at Blue Label Telecom's results for the 6 months ending November. Some analysts calling the numbers quite messy. Why?
Yeah, that is messy because there's any number of profit line items depending on pre-contribution and post-contribution. It's all clouded by the contributions to Cell C, all around that recapitalization, etc., etc. And if you add back the previous year and take out this year, then you're seeing better or worse numbers. So it becomes hard to look through the noise and find what the core business is doing. According to Blue, the core business is stable, around 12% increase in earnings. But yeah, I haven't looked through it in deep detail, but it certainly is a noisy set of numbers.
And Mondi also has some numbers out today. Unpack those for us, please.
So those are tough. I mean, it was a tough update. Revenue down 18%, core HEPS around 50% down. I think what's important is to remember that it is very much cycle lows, again, for the paper and packaging industry. There's been a big destocking of inventory post-COVID. We had the overstocking, and now we've had the inventory destocking. We've seen these inflation pressures, cost pressures playing out across all these industries. And so on the face of it, the numbers look challenged, but the cash generation is still good. It's still there. The debt is still manageable, comfortable levels. They continue to invest in growth capex and through the cycle investments. So foundationally, the foundation's still in place. It's a cyclical industry. I don't think there's anything concerning in the numbers given where we are in the cycle. And so tough operating environment for them, but they're still doing all the right things in all the right places in those things they can control. Now that is notwithstanding that the potential merger type of conversation around the DS Smith, we think that is a different conversation, and I don't see that in the same light. But that is not yet on the table, and so in terms of what we can see, this looks solid enough.
All right. It sounds like cyclical is the buzzword for our interview today. Grant Nader, let me thank you for your time this afternoon. Senior Portfolio Manager at Benguela Global, joining us for your latest market moves.